For this particular session, we will talk about your hedging and your derivatives. So with your hedging and derivatives, our main focus only is the hedging of a foreign currency risk. So our main focus is the hedging of a foreign currency risk. And to hedge that, we will use your derivatives. But before we go with your derivatives, we start first and know the concept of hedging. So what is hedging? Hedging is making an investment or acquiring some derivative or non-derivative instruments in order to offset potential losses or gains that may be incurred on some items as a result of a particular risk. So what's important here to remember in this particular definition is to know that there is a risk or a particular risk. In our case, we talk about your foreign currency risk. And then we have your derivative. So we use your derivative to offset the risk. Okay, so if ever we can liken it to a ring. So this is your rain, so downpour of rain. And we have here your umbrella, okay? And you are here, okay? So ikaw yung nandito, may ulan, anong kailangan mong gawin para hindi ka mabasa ng ulan? So ang kailangan mong gawin ay dapat meron kang umbrella. So this whole process is known as your hedging. Okay, this whole process is known as your hedging because there is a risk that mabasa ka ng ulan at baka magkasakit ka pa. So anong kailangan mong gawin? To protect yourself, kailangan mo ng umbrella. So dito naman, in your hedging, this particular rain is considered as your risk. And the umbrella is your derivative. Ito naman is the company. So what we have here is to protect ourselves out of the risk, we need to get your derivative. So hedging, take note, you make your investment out of your derivative to offset losses because of the risk. So our risk here is the rain, and the umbrella is considered your derivative, and this person is considered the company. So we make use of your derivative so that we offset a risk or we do not have or we will not incur any losses. So this whole process is known as hedging. That's why your hedging and derivatives will always go together because one important portion or one important element to hedge is the use of your derivative. Your derivative here is known as your hedging instrument. Okay? So since we talked already about your hedging instrument, we discuss your components of your hedging. Okay. So what are your components of your hedging? So first component is your hedge risk. So what is this hedge risk? This hedge risk is any event which of course poses any adverse effect on the company. So any event, any risk that could possess adverse effect on the company. Generally, we call this one your financial risk. And when we talk about your financial risk, we have your different types of risk, such as your foreign currency risk, your interest rate risk, your credit risk. If you still remember, your risk, your different types of risk under your AE 115. But here in AE 120, what we particularly talk about when we discuss hedge risk, what we will hedge is the risk of a foreign currency. So when we talk about foreign currency risk, again, this is the risk that the foreign currency will increase or decrease. Therefore, we can have either loss or gain. So what we want to do is to offset that increase or decrease. Hedge risk. So in our in our illustration, wait. So in our illustration, this is our illustration. If you still remember our illustration, okay. So we said in our illustration, this whole illustration is your hedging. So this is the concept of your hedging. So this rain is likened to your risk, which is known as your hedge risk. Okay, next. we talk about your hedge item. So when we talk about hedge item, this is the item that you protect out because of a possible risk. So this is the item that you protect because of the possible risk. So what are your hedge items under accounting? So we have four hedge items under accounting. The first hedge item first hedge item is known as your recognized asset or liability or your exposed asset or liability. So we know this one as your uh, money items, if you still remember. So in a foreign currency, we have your money items. These are your recognized asset or liability. This is the receivable, which is denominated in a foreign currency, or a payable, which is again denominated in a foreign currency. Next type of hedge item is your unrecognized firm commitment. So what is this unrecognized firm commitment? So if you still remember your AE 105, you have there a firm commitment wherein there is a future purchase. However, there is no commitment yet with the company. So this unrecognized firm commitment talks about a future purchase or a future sale. Next type of hedge item is your highly probable forecast transaction. So when we talk about highly probable forecast transaction, these are transactions that are planned but not yet committed. And lastly, your net investment in foreign operation. You already know this one. This is known as your foreign subsidiary. Okay, so we talk already of your hedge risk. So in this illustration, we liken your hedge risk as the rain. Next, your hedge item. In this illustration, your hedge item is the person. Hedge item. So what is our particular focus on our hedge item? If our particular focus for hedge risk is the foreign currency risk, our main hedge item, which we have just finished, is your recognized asset or liability, including net investment in foreign operation. Because what do we have here? This recognized asset or liability is known as your foreign currency transaction. Net investment in foreign operation is your foreign currency translation. Therefore, out of our two foreign currency topics, which is your transaction and translation, we will now hedge the risk. Hedge the risk. Okay? So our hedge risk is the foreign currency risk out of your foreign currency transaction and translation. What do we call this foreign currency transaction and translation? These are your hedge item. So when we talk about hedge item, apat lang yan. It's either recognized asset or liability, unrecognized firm commitment, highly probable forecast transactions, and net investment in foreign operation. Next, we talk about your last component of hedging, which is your hedging instrument. Okay, so we said the ring is your hedge risk, and then the person here is your hedge item. How about the protection that you use? The protection that you use, which is the umbrella, is your hedging instrument. So that is your hedging instrument. So when we talk about your hedging instruments are your derivatives. Your hedging instruments are your derivatives. That's why when we talk about hedging, we also talk about your derivatives because again, hedging, one important component is your derivatives. Okay? So as we said a while back, derivative is your hedging instrument. So again, hedging, what's the whole process? There is a risk. You need to protect yourself with that particular risk. So you purchase a derivative. That is the process of hedging. And what are the components? First, the risk. Second, the hedge item, which can either be the foreign currency transaction or foreign currency translation. And then we have your hedging instrument, which is in the form of your derivatives. Now we talk about your hedging. Your hedging has three main categories. So what are your categories of your hedging? The categories of your hedging is provided under PFRS 9. And there are three types of hedging. First is your fair value hedge. Next, we have your cash flow hedge. Lastly, we have your hedge of a foreign investment, or that is your hedge of a foreign operation. So first, we have your fair value hedge. The first hedge is your fair value hedge. We need to know the components of your hedging. So what are your components of your hedging? So you already know that there are three components. First, the hedge risk. Second, the hedge item. Third is your hedging instrument. So in a fair value hedge, what is the hedge risk? The hedge risk is the fair value changes because this is a fair value hedge. What you will hedge is the fair value. Therefore, what is the risk here? The risk is the fair value changes. When we talk about your fair value changes, this is the changes on your foreign currency. So what is your hedge item? Remember, we have four hedge items. What are the four hedge items again? The first is your recognized asset or liability. Next is the unrecognized firm commitment. Next, we have your highly probable forecast transaction. And lastly, we have your foreign operation. So if ever we have a fair value hedge, what is the hedge item? The hedge item is only your recognized asset or liability and your unrecognized firm commitment. So if there is a change as to the fair value of your derivative instrument, which is your hedging instrument, we place it in your profit or loss. Next, we have your cash flow hedge. Your cash flow hedge, what we hedge here is your cash flow. Therefore, what is the risk? The risk is the changes in your cash flow. If a while back, the change in your foreign currency or your fair value, now the change in cash flow. Among the four hedge item, what are the items that can be under your cash flow hedge? We have only three: recognized asset or liability, highly probable forecast transaction, and net investment in foreign operation. And here, we need to look into your effective and ineffective portion. The effective portion is placed in OCI, while the ineffective portion is placed in profit or loss. Last type of hedge, hedge of a net investment in foreign operation. Therefore, what do we hedge here? The foreign operation. Then your hedge item is your net investment in foreign operation. Still, we have your effective and ineffective portion. Always remember that effective portion is placed in OCI and ineffective portion is placed in your profit or loss. Later, we will discuss how to compute for your effective and ineffective portion. Okay, so we have four hedge items. What are those? Your recognized asset or liability. We also have your firm commitment. And we have your highly probable forecast transaction. And lastly, we have your net investment in operation. So it can either be a fair value hedge or a cash flow hedge. We said you can fair value hedge asset and liability and firm commitment. You can cash flow hedge asset or liability, highly probable transaction, net investment in foreign operation. Take note the applicability of your hedges. So under PFRS 9, you can only use fair value hedge on two items: the recognized asset or liability and firm commitment. And you can use your cash flow hedge among three items: asset or liability, highly probable forecast transaction, and net investment on foreign operation. In short, firm commitment can only be fair value hedge. Highly probable forecast transaction and net investment in foreign operation can only be a cash flow hedge. While your recognized asset or liability, we have your fair value hedge. Our main focus only is your recognized asset or liability, which can only be accounted at fair value hedge or cash flow hedge. But our focus is your fair value hedge. Our main focus later is your fair value hedge. Okay? Now we go with your derivatives. You already know what is a derivative. Your derivative is your hedging instrument. Okay? So out of your different hedge items, we can make use a derivative. So what is a derivative? A derivative is A financial instrument on other contract that derives its value from the changes in value of some other underlying asset or other instrument. So one important item here is your underlying asset. The question is, what is an underlying? An underlying is known as a variable. It is known as a variable, either financial or physical variable, that has observable changes or verifiable changes, such as your interest rates, because you can observe their change, market rate, because you can observe their change, forex rate, which is your foreign exchange rate, because you can again observe their change. Okay, so again, underlying asset is a variable that you can observe the changes. Clear? Okay. Next, we look into your characteristics of derivatives. First, its value changes in response to an underlying. You already know an underlying. This value changes, therefore, the value of your derivative, take note, it only derives value out of your underlying. Okay? It derives value out of your underlying. So kumbaga, manggagaling yung value ng derivative sa underlying. So pagka merong changes sa underlying, of course, your derivative will always change. Kasi nga manggagaling yung value niya sa underlying. And take note, underlying are different variables in which you can look into your changes. So in case there is a change here, of course, there will be a change in your derivative. Next, it requires no initial net investment or very minimal initial net investment. Generally, this is only zero. Okay, so the value of your derivative at the beginning is zero, except for options, because options have an option money, and that option money is considered as your minimal initial net investment. Okay, so derivatives generally at the beginning, the value is zero. However, the exception there is your option, because your option can have a value based on your option money, and that is your minimal net investment. And lastly, it is settled at a future date. So take note, we have here your hedge item and hedge instrument. What are your hedge item again? Sabi natin, isa lang i-discuss nating hedge item. That is your recognized asset or liability. Ano uli yung recognized asset or liability? Saan nanggaling yan? Sa foreign currency transaction. Okay? So dalawa yung ina-account natin dito, yung hedge item at hedge instrument. Ano yung hedge item? Yung recognized asset or liability, which is the foreign currency transaction. Ano naman yung hedge instrument? Ito yung different derivatives. Ito yung different derivatives. Okay? So, we account for two items here. We look now into your determining factors for a derivative. So what are your determining factors? First, underlying, you already know this one. These are different variables and they have observable changes. What is new is your notional amount. So your notional amount is your fixed variable. Your fixed variable. So normally these are your currencies and other units. Okay? These are currencies and other units. So this is normally specified in the contract. Next, what is the purpose of derivatives? First is to speculate. This is, of course, to incur risk because you are speculating for a derivative. And next is to hedge, which is to avoid or manage risk. So what we talk about for this particular topic is the hedging to avoid or manage risk. Okay, we go back. What is the risk? We call this one your hedge risk. And then we have here your person. What do we call this person? This person is your hedge item. And then we have your umbrella. Your umbrella is your hedging instrument. So what do we account? Based on our introduction, what we will account? Two items. We account the hedging instrument, which is the derivative. And we account the hedge item, which is the foreign currency transaction. You already know how to account for your foreign currency transaction. Our main focus now is your derivatives. So how do we account for your derivatives? So the measurement of your derivatives, all derivatives are measured at fair value because generally your derivatives are accounted under fair value hedge. The accounting for fair value changes depends on whether the derivative is not designated as a hedging instrument, designated as a fair value hedge, and designated as a cash flow hedge. If it's not designated as a hedging instrument, what do we call this type of hedge? Or what do we call this type of derivative? Diba? There are two purposes of derivatives, to speculate and to hedge. You already know cash flow and fair value hedge. This is one purpose, hedging. So how about not designated as a hedging instrument? What do we call this purpose? This is the purpose of a speculation. If it's speculation, how do we present it? If ever it is not designated as a hedging instrument, we place it as an investment either under FVPL or FVTOCI. Okay? But generally, it is FVPL. Generally, it is FVPL. Next, designated at fair value hedge. How do we measure your fair value here? We place it in your profit or loss. Cash flow hedge, depending on your effective portion and ineffective portion, we said. If that is effective portion, the cash flow hedge, we place it in your OCI. Ineffective portion, we place it in your profit or loss. Do not forget this whole idea or whole picture of your derivatives. Once you know the whole idea or picture of derivatives, it's easier for us to account for it. Take note, we account for two items: the hedging instrument, which is the derivative, and the hedge item, which is your foreign currency transaction. And take note, we offset whatever is the gain or loss. So in a foreign currency transaction, if there is a gain, we offset it by a loss. So in a derivative, there will be a loss. If there is a loss on a foreign currency transaction, then we have a gain on a derivative. Remember that. What is the purpose of derivative? To offset whatever is the gain or loss. So the gain or loss in a foreign currency transaction, if there is a gain, then on derivative, we have a loss. If we have a loss on the foreign currency transaction, then we have a gain on the derivative. Take note of this again, please. We account for two items, derivative and foreign currency transaction. So if there is a gain in foreign currency transaction, it is a loss on the derivative. If it's a loss on the foreign currency transaction, it is a gain on your derivative. So what are the types of derivatives? Let's start first with your first two types. We will only discuss four types of derivatives. So what are the four types? We have forwards, futures, options, and swaps. Mainly, we will discuss these three items, not swaps. So forward, futures, and options only. So first, forward contract. Forward contract is an agreement between two parties to exchange a specified amount of a commodity, security, or foreign currency at a specified date in the future at a pre-agreed price. So exchange at a specified date in the future at a pre-agreed price. Next, futures contract. It's a contract traded on an exchange that allows an entity to buy or sell a specified quantity or commodity or a financial security at specified price on a specified future date. So they are both the same. You will exchange at a particular date at a particular price. So at a particular future price and at a particular future date. They are the same with the definition. But as you can look, first one is only an agreement, but on the second one, it is traded on an exchange. So by now, you should have an inkling on what is the difference between a forward and future contracts. So let's look at the differences. First, forward, they are private contracts because they are only an agreement. Futures, they are traded in the market. So take note, they are traded on an exchange. Forward, since this is a private contract, it is a customized contract. Okay? Since it is a private contract, it is a customized contract. While in your futures, since it is traded, it is standardized. Forward is settled by actual delivery, while futures are settled by a net cash payment. Futures are settled by a net cash payment. Okay, so there are two types of derivatives that we first discussed, forward and futures. They are almost the same. You need to exchange at the future price at the future date, and then we account for any changes on this particular price. Okay, so date of contract, balance sheet date, and then we have your settlement date. So we look into your forward or future rates. Again, get the differences. Get the differences. The differences are now accounted. Similar, right? It is similar to a foreign currency transaction. You just need to get for the differences and account for it. But here, take note in a foreign currency transaction, if it is a gain, in a derivative, it is considered a loss. Okay? So kung sa transaction, ni-record mo siya ng gain, eh sa derivative, i-record mo yan ng loss. Next, if doon sa foreign currency transaction, nag-record ka ng loss, sa derivative, nag-record ka ng gain. Dalawa yung account natin, foreign currency transaction and your derivatives. How do we account for your gain or loss on your derivatives? That's how. You just compare the differences and you account for those differences. Let's have an example. On December 15, 20X1, ABC Company sold goods to a Japanese firm for 4 million yens. ABC Company was concerned about the fluctuation in the Japanese yen. So on this date, ABC entered into a 30-day forward contract to sell 4 million yens for 1,880,000 to a bank at a forward rate of 0.47. Okay. So we account for two items here, the forex transaction, and then the derivative. Okay. What do we use on your forex transaction? The spot rates. Alam naman na ninyo yan. Sa derivative, yan yung forward rate or yung futures rate. So what is our foreign transaction? Our transaction is a sale. Okay? Our foreign transaction is a sale. What is the rule on the sale? If ever the foreign currency increases, there is a gain. If the foreign currency decreases, it is a loss. Clear? Okay. So let's account first for your foreign currency transaction. So 0.48, 0.49, 0.46. So from 0.48 to 0.49, there is an increase of 0.01. From 0.46 to from 0.49 to 0.46, we have a decrease of 0.03. What is our fixed variable? Our fixed variable is 4 million. What do we call this 4 million? This is the notional amount. How about the exchange rates? We call this one as your variable changes. These are your underlying. Okay, I hope you still remember that. So what is our notional amount? 4 million. So times 4 million times 4 million. How much is for the first one? 0.01 times 4 million, 40,000. Since increase, we have a gain. This is a decrease. 0.03 times 4 million, we have 120,000 decrease. So this is considered a loss. So we're done accounting for your foreign currency transaction. Okay? So the foreign currency transaction is a sale. If there is an increase, it is a gain. If there is a decrease, it is a loss. Alam nyo na yan. Now for derivative. For derivative, we account 0.47, 0.485, and then 0.46. So this one is 0.015. This one is 0.025. Okay, so there is an increase here. There is a decrease. Okay, so we said the gain on the transaction, di ba may gain dyan? The gain on a transaction is a loss on the derivative. And a loss on a transaction is a gain on a derivative kasi mag-o-offset dapat sila. Nasusundan? Okay. So first, what is the amount of our loss? So we have a difference of 0.015. 0.015 times 4 million, we have 60,000 loss. And then for gain, we have 0.025 times 4 million, we have 100,000 gain. Okay? Nasusundan ninyo? Ulitin natin. Dalawa yung i-account natin, yung forex transaction. We call this one as your hedge item. Yung derivative, which is a forward, we call this one your hedging instrument. Ano yung rule? Yung gain sa transaction is a loss on your derivative. A loss on your transaction is a gain on your derivative. Ganun siya. Nasundan? Okay. Now, we are ready to account for it. Ang dali, di ba? Parang foreign currency transaction lang siya. Yun nga lang guys, kailangan ninyong intindihin dito, dalawa yung i-account. Transaction at saka yung derivative. Tapos kailangan magkabaliktad sila. Kung gain dun sa una, sa transaction, loss naman sa derivative. Kung loss dun sa transaction, gain dun sa derivative. Okay? First, what is the forex gain or loss? O kung forex, punta tayo sa forex. Meron tayong gain, 40,000 gain. Kasi ito yung December 31, di ba? Ito naman yung January 15. So yung unang difference is December 31 difference, January 15 difference naman yan. Okay? 40,000 gain. Next, how much is the gain or loss on the change on the fair value of derivative? So derivative naman tayo. So, sa derivative, meron tayong 60,000 loss. Okay? Sa derivative, meron tayong 60,000 na loss. So, we have a 60,000 loss on your derivative. What is the derivative asset or liability to be included? So, since we have a 60,000 loss, how do we record that one? So, we have your loss on derivative. Alam na ninyo mag-record ng gain or loss sa foreign transaction, no? So doon tayo sa derivative mag-focus. Loss on derivative on December 31 and then forward contract liability amounting to 60,000. Okay, so we have a forward contract liability, 60,000 pesos. Next, how much is the forex gain or loss on January 15? So we have already computed that. We have 120,000 loss. Okay, 120,000 loss. Next, how much is the forex gain or loss? How much is the gain or loss in the change of fair value of the derivative on January 15? Na-compute na rin natin yan. Magkano? 100,000 gain. So this is 100,000 gain. Next, if the forward contract is settled on a net cash basis, how much is the net cash settlement? Okay. So kung net cash basis yan, paano daw natin i-record? Since meron tayong 100,000 gain, i-record natin yan as your gain on derivative contract. 100,000. We remove your foreign currency liability or foreign currency daw. Forward contract liability, which is 60,000. Magkano natira? 40,000 pesos. That 40,000 pesos is known as the cash that you will receive net. So 40,000 net. So ang sagot natin, 40,000 net. Lastly, what is the total net effect of the two contracts in 20x1 and 20x2 profit or loss? Okay, so for 20x2, if we have 60,000 loss, and then, okay, so look into your gains and losses. So for 20x1, we have 40,000 gain on the foreign currency. And then on the forward, we have 60,000 loss. And then on 20x2, we have 120,000 loss on the foreign currency. And then for your forward contract, what do we have? 100,000 gain. So what is the net gain or losses? 40 less 60 less 120 plus 100. We have here net loss of 40,000. Net loss of 40,000. So that will be our answer. Net loss of 40,000. O, di ba? Napakadali. Madali lang siya. Kailangan lang ninyong account yung dalawa. Yung transaction, alam na ninyo yan. Yung derivative, mag-compare lang kayo. Same lang din. Yun nga lang, spot rate yung gagamitin sa transaction. Doon sa derivative, ang kailangan ninyong gamitin is yung forward rates. Yung gain doon sa derivative, so kung may gain dito, yun naman yung loss doon sa kabila. Kung may loss doon, yun naman yung gain sa kabila. Ganon. Ganon yung pag-account natin sa gains or losses. Okay? So pag tinanong kayo, what is the forex gain? Di doon sa foreign currency transaction, the gain or loss on the derivative, ang kailangan nyo lang gawin is to compute for your changes in your rates based on your derivatives. Pag tinanong naman net effect, di tingnan nyo yung effect niya. 2000x1 at 2000x2, may 40,000 gain tayo nung una. Tapos nagka 60,000 loss sa derivative, 120,000 loss sa foreign currency, 100,000 gain naman sa forward. Net is 40,000. Nasundan? So sale to sale. Next naman, purchase. Next example, purchase. On December 15, 2001, ABC Company purchased goods from a Korean firm for 40,000 wons. ABC Company was concerned about the fluctuation in the Korean won. So on this date, ABC Company entered into a 30-day forward contract to buy 40,000 wons for 49,600 at a bank at the forward rate of 1.24. So again, 40,000 represents your 40,000 represents your notional amount. And the rates represents your underlying. So we have here a purchase. We have here a purchase. So since this is a purchase, what is the rule on your purchase? If the price will increase, we have a loss. If the price will decrease, we have a gain. So first, we account for your foreign currency transaction. So what are the rates? December 31 X1 and then 115 X2. So the rates are 1.2, 1.26, and 1.30. So here we have 0.06 difference increase. So this is a loss. Next, we have another increase of 0.04. This is another loss. Okay. So 0.06 is the first one, right? 0.06. So 0.06, 0.06 multiplied by the notional amount of 40,000. We have here 2,400 loss. 0.04 times the notional amount of 40,000, we have 1,600 loss. That's for foreign currency transaction. Next, we account now for the derivative, which is the forward. Okay. So if the increase there in your foreign currency transaction is a loss, the increase now here is considered a gain. And the decrease, kailangan magkabaliktad sila, di ba? And the decrease is considered now the loss. Ganun siya. So we plot again the rates, 1.24, 1.27, and then 1.30. So this is 0.03 increase. If there is an increase, there is a gain. Another 0.03 increase, this is considered a gain. So 0.03 multiplied by the notional amount of 40,000, it's not 12,000. it is 1,200, 1,200 gain, and this one again is 1,200 gain. So since we're done computing, we are ready to answer our problem. First, the purchase inventory shall be recognized at, okay, so you will recognize the inventory at the date of purchase. So what is the date of purchase? December 15, the rate is 1.2. So 1.2 multiplied by the notional amount of 40,000, 48,000. You already know that one. That is under your foreign currency transaction. Next, the derivative asset or liability to be included on December 31. So on December 31, remember we have 1,200. Diba? 1,200 gain. So if that is the gain, how do we record it? So we have your gain on derivative, and then we record it as a forward contract receivable or asset, 1,200. So our answer is 1,200 forward contract asset. Okay? So, 'di ba? Kanina, ang example naman natin is loss on derivative, may forward contract liability tayo. Ngayon naman, may forward contract asset tayong 1, 2. The adjustment to the inventory account. Do we adjust your inventory? No. Why? Because inventory is non-money. Remember, what we will adjust in me is your money. Next, the how much is the forex gain or loss on foreign currency on January 15? So on January 15, if we try to look, we have here 1,600 loss. We have computed that a while back. 1,600 loss. Next, how much is the gain or loss in the change on fair value on January 15, 2000 X2? So we have 1,200 gain. Okay? 1,200 gain, as we have computed a while back. The net effect of the two contracts on the profit or loss is in 2000 X2. So 2000 X2, we look only. So January 15 X2, dun tayo mag-focus. On your foreign currency transaction, we have 1,600 loss. And then on foreign forward contract, we have 1,200 gains. So the net effect is 400 loss. So the net effect is a 400 loss. So our answer is 400 loss. And then last, assuming that the forward contract is settled on a net cash basis, how much is the net cash settlement or receipt? Okay. So on our last recording, pag net cash basis, ano uli? I-record natin yung gain, which is 1,200. Tatanggalin natin yung forward contract receivable na 1,200. So how much is the cash? 2,400. 2,400. So our answer, cash, 2,400. Okay. So we're done with forwards and futures. Remember, in forwards or futures, what is important? You need to take a look whether there is a gain or loss on your derivatives. So how will we know if there is a gain or loss on your derivatives? We account for your foreign currency transaction, and then we account also for your derivatives. Please remember, if there's a gain on a derivative or if there's a gain on a transaction, that is a loss on the derivative. If there is a loss on the transaction, that is a gain on the derivative. Okay? Once you master how we do these items, it is easier for you to answer problems concerning forwards and futures. We go now to the next type of derivative, options. So we're done with forwards and futures. We discuss now your options. So for options, option is a contract giving the holder a right, but not the obligation to buy or sell an asset at a specified price anytime during a specified period in the future. When the holder exercises right, the writer of the option is obligated to perform his obligation on the option contract. So take note, option, you have only the right, but not the obligation. And your option can either be a call option or a put option. So when we say call option, you have the option to buy. A put option is an option to sell. Call option is an option to buy, and a put option is an option to sell. So how do we compute for how do we determine if ever we will exercise your right or not? So it depends whether the call or put option is uh, at the money, in the money, or out of the money. So we have these different terms: at the money, in the money, and out of the money. So normally, the specified price is known as your strike price, right? The specified price is your strike price. So what we compare here is your strike price. If the strike price is equal to your market price, or your strike price is lesser than your market price, or your strike price is greater than your market price. So it is considered at the money if ever it is equal at your market price. It is considered in the money if ever it is a strike price greater than your market price for put option. And it is considered in the money if ever the strike price is lesser than your market price for a call option. Sir, bakit kailangan yung strike price greater sa market price pag put option? Pag put option kasi, ang kailangan mong gawin is bibili ka, 'di ba? Bibili ka. So, pag yung market price mo ay hindi, option to sell pala yung put option. So, magbebenta ka. So, your strike price should be greater your market price. So, if you have the option to sell, let's say your strike price is 50 and the market price is 40. So, what will you do? Of course, ibebenta mo yan. Kasi nga, doon sa option mo, you can sell it at 50. Pero, kung ibebenta mo lang sa market yan, 40 siya. So, what do you do? Pag strike price is greater than the market price for a put option, we call it in the money. When we say in the money, you should exercise the option. Okay? Kasi kikita ka. Biruin mo, mabebenta mo siya at 50, pero yung market price lang ay 40. That's for put option. If you have the option to sell. How about a call option? You have the option to buy. So in a call option, the strike price must be lesser than their market price. So for example, on your option contract, it is 50. Then your market price is 40. So what will you do? Will you exercise the option or not? Of course, you will not exercise the option. You will only exercise the option if ever the strike price is lower than your market price. So alangan naman, gagamitin mo yung option para bumili ng 50, pwede mong bilhin sa market at 40. So if ever it is lesser, strike price is lesser than your market, doon ka lang magko-call option. So doon lang siya magiging in the money. So in short, pagka yung strike price mo ay 30, pero yung market price mo ay 42, since the strike price is lesser, of course, it is in the money. You will exercise the option. Kasi nga, mabibili mo siya at 30, pero bibilhin siya at market 42. So it would be better for us to at least purchase it now since the strike price is lesser. And when do we say it is out of the money? It is out of the money in a put option if it is lesser than the market price, the strike price is lesser, and it is out of the money in a call option if ever the strike price is greater than your market price. Okay, so remember, when is it in the money and out of the money? It is different in between call and put option. So in the money in a call or put option is different. And then out of the money in a call or put option is also different. Okay? When do we exercise the option? If it's in the money. So I know you have discussed this one in your financial management. When can we say it is in the money, out of the money, and at the money. Just remember, call option is an option to buy, put option, that is an option to sell. So how do we account for your options? For accounting for options, the option premium is equal to your intrinsic value plus your time value. Normally, your option premium is equal to your fair value. Your time value, normally it is given on the problem. If it's not given on your problem, your time value is equal to your option premium less your intrinsic value. Your time value is equal to your option premium less your intrinsic value. So your option premium is known as your payment for the option or the fair value of the option. The intrinsic value is the change in spot rates. So what we look here is the spot rates versus the strike price. We have here your change on your rates. So this change on rates multiplied by your notional amount is recognized in OCI. Change in rates multiplied by your notional amount is part of your OCI. So generally, spot rate versus spot rate lang naman yan. Your time value, how do we compute ulit? Based on your fair value, which is your option premium or your total fair value of the option, less your intrinsic value, then we have your time value. Your time value is your ineffective portion, profit or loss. Take note, effective OCI, ineffective profit or loss. So how do we compute for that? So generally, from your different dates, you have different dates, right? Date of option or date of transaction, then balance sheet date, then we have your settlement date. So what do we do here is we get for the fair value of the option. So fair value of option, which is always given. The fair value of the option here is the option money, while the fair value of the option at the settlement date is equal to the intrinsic value. Next, intrinsic value. How do we compute for your intrinsic value? Again, is spot rate less your spot rate. This is equal to your multiplied by notional amount. That is your intrinsic value. That is the same among all of the others. And time value is equal to your fair value less intrinsic value. Fair value less intrinsic value. At the end, this is zero. Why? Because we said fair value is equal to your intrinsic value at your settlement date. Fair value is equal to your intrinsic value at your settlement date. Therefore, the time value should be zero. The time value should be zero. Okay, let's try to make or have an example for us to understand the accounting for options. Take note, the intrinsic value, the changes are placed in your OCI. For time value, they are placed in profit or loss. So let's have an example. On January 1, 2013, Lucky Incorporated paid 9,800 to acquire a put option. This is in relation to the sale of merchandise worth $65,000. Strike price is 4.965, and we have your different spot rates and your fair value. How much is the foreign currency gain or loss on the intrinsic portion on March 31, 2013? So what is asked here is your intrinsic portion, therefore change in your intrinsic value. Okay? Intrinsic value. So for intrinsic value, this is known as your effective portion. So how do we account for it again? We place the dates 1/1/13, 3/31/13, and then 6/20/13. And then we get for your fair value of the option, which is 9,800 as given, 11,400. And then this is 13,935. Next, we compute for your intrinsic value of your option. So how do we compute for your intrinsic value of your option on our first problem? So we have here 4.965 as the initial, which is your strike price, less your spot rate of 4.934 multiplied by our uh, multiplied by our notional amount of 65,000. How much then is our intrinsic value on January 1, 4.965 less 4.934 times 65,000. We have here 2015. So what is our time value? Our time value is equal to fair value less intrinsic value. So to compute, our fair value is 9,800. Our intrinsic value is 2015. 9,800 less 2015, we have here 7785. Next, March 13, we have 4.908. So like this, we compare it there. We compare naman 4.934 with 4.908 multiplied by 65,000. 4.934 less 4.908 multiplied by 65,000, we have here 1,690. And then on our, I know, mali. Wait. So what we compare here is again, the strike price versus your spot rate, as we said. Our strike price is 4.965 pala. Sorry. 4.965. 4.965 less 4.908. We have times 65,000. We have 3705. And then last, we have 4.965 plus 4.75 times 65,000. We have 13, this should be 13,975. As we said, this must be equal. So, kailangan pareho sila. This will be 0 na. How about the time value on our March 31, 13? So we have a fair value of 11.4, and then we have 3705 as the amount of our intrinsic value. 11.4 less 3705, we have 7695. So how do we account for that? So we account for your intrinsic and your time value, we said. So 1113, 33113, and uh, June 2013. So we have already computed our intrinsic value, 2015, 3705, and 13975. For our time value, we have 7785, and then 7695. Also, we have 0. So we just compare the differences. So 2015 versus 3705, we have 1690. This one is 90 loss. This one increased, therefore a gain. This one decreased, therefore a loss. Here, 3705 versus 13975. 13975 versus 3705, we have a gain of 10 to 70. And then here, we have a loss of 7695. Okay. So, ganyan yung pag-compute natin, strike price less spot rate. Ayan. Strike price less spot rate for our intrinsic value. And for time value, we have your fair value less intrinsic value. So let's compute now. What is the gain or loss on your intrinsic on March 31? So intrinsic, punta tayo ng intrinsic value. March 31, we have here 1690. So we have 1690 gain. 1690 gain. Where do we place this one? OCI. This one is profit or loss, profit or loss. Okay? So since yung tanong lang naman is March 31, ang sagot natin 1690. Pero wag niyong kalimutan yung pag-compute kung paano ng fair value, intrinsic value, and time value. Let's have another example. GV company anticipates the price of cement will increase the coming months. Therefore, it decides to purchase call options on cement as a price risk hedging device to hedge the expected increase in prices on a forecasted purchase of cement on December 1, 2013. GV purchased call options of 1,200 sacks of cements at a premium of 5 pesos per sack. So that is the amount of our option price. So 5 pesos per stock. So after our option price, we have now your different market price. So dates December 1, we also have December 31, and then we have March 31. Okay. So we get the fair value of your option. So what is the fair value of our option? Our fair value of option is based on our option premium. So our option premium, we have computed it 5 multiplied by 1,200 stocks. We have 6,000. And then on December 31, we have a fair value of 7.5. And then we said the intrinsic value at the end of March 31 is also your March 31 value as to your fair value. So how do we compute? Strike price, which is at 165, and then the current price or spot rate 172 multiplied by the number of stocks 1,200. So we have here 7 times 1,200, 8,400. Let's compute for intrinsic value on December 1. So we have again 165, which is our strike price. Ayan siya, 165. So after we compute for your strike price of 165, we compare it to your market price, 165 times 6,000 times 1, 2. So this is 0. On December 31, 165, that's 168 times 1, 2. This is 0. I know. 3 versus 1, 2, 3,600. Next, we compute for your time value, 6,000 times 6,000 less 0, 6,000. This one, 7.5 less 3.6, we have 3.9. And then 8.4 less 8.4, we have 0. Okay. So for your intrinsic value, we have the following amounts: 0, 3.6, and 8.4. Where do we place the changes? In OCI. So there is an increase, 3.6 gain. There is another increase, 8.4 less 3.6, 4.8. So this is placed in your OCI. Time value, initially we have 6,000, and then we have 3.9, and then we have 0. So we have here a loss amounting to 6,000 less 3.9 to 1. And this is 3.9 loss again. So after that, we can already answer the problem. So if the problem asks you how much is the amount of gain or loss presented in OCI for 2013, ito yung sagot nyo. OCI 2014, ito naman. Profit or loss 2013 yan, 2014, 3.9. Pero ang tanong kasi dito, how much is the net income? So to compute for your net income, we compute first for our sales. So how much is our sales? We sold 1,300 for 176 per sack. So 176 times 13, 228,800. Next, we compute for our cost of goods sold. So for our cost of goods sold, we exercise the option. What is our option again? We have 1,200 stocks. 1,200 stocks multiplied by our option price of 165. We have 198,000. And then we have excess of 100. Why? Because we sold 1,300 and we only purchased the one two for 165. So we have excess of 100. 100 times the market price at the end, which is 172. We have here 17,200 less the loss on option. Time value, di ba sa profit or loss yan? So 39. Magkano din ang ating profit or loss? 228,800 less 198 less 17,2 less 39. Our income is 97. So if you are asked what is the net income, your answer is 97 based on this particular example. So again, how do we compute for the gains or losses here? For intrinsic value, place in OCI. For time value, place in profit or loss. How do we compute for your intrinsic value? That is equal to your strike price less spot rate. So 165 less 165. 165 strike price less spot rate on December 31, 168. And then 165 strike price and 172 spot rate multiplied by the notional amount, which is 1,200 subs. After that time value, that is equal to your fair value less intrinsic value. Okay? So we're done with forwards, futures, and options. And we will just discuss the last one type of derivative, but we will not discuss an example for this. So the last is a swap. Swap is a contract in which two parties agree to exchange payments in the future based on the movement of some agreed upon price or rate. So you will swap whatever is agreed upon. So for example, interest rate, you will swap one party, so party one, and then party two will exchange rates. That's how it is used to be. So exchange rate one to rate two. Rates, interest rate swap and foreign currency swap. So interest rate swap is the contract between two parties to agree to exchange future interest payments. And a foreign currency swap, you will exchange foreign currencies between one person to another. So you will just swap whatever you want to swap, whether that is interest rate or a foreign currency swap. So that's it for our hedging and derivatives.